All right, so if we remember from Thursday, we're looking at going concern, it means that unless you have evidence to the contrary, your business will continue to operate for an indefinite period, not infinite, long enough to carry out contemplated operations, a strategic plan, long enough to pay off its liabilities, long enough to use up its productive capacity. This will justify the depreciation of an asset for 40 years. This will justify the short-term, long-term, particularly long-term classification on the balance sheet. And it's also going to justify the use of historical costs, because the last thing we said was that if a business is a going concern, then its plant assets, its productive, its buildings, its factories, its machinery would not be for sale, and therefore market values are not relevant, so cost becomes the main valuation basis for something you're not going to sell. If you were in bankruptcy, you're going to sell the business or liquidate the business, then market values will in fact be relevant. And I think I mentioned the last thing I told you, working on the bankruptcy, I know that all of the assets, liabilities, everything is valued at liquidation value. Everything's for sale when the company is in bankruptcy. So then you would no longer have a going concern, and you would use liquidation or fair values. Right, so that's where we left off. Now, conservatism, although it is not really part of the conceptual framework itself, it is something we use every day. And that is essentially that if you're given a choice between two accounting methods or two valuation alternatives, you're going to use the one that's least likely to overstate assets and income. Now, to make sure that's clear, we're saying that it is least likely to overstate assets and income. Saying that if you're practicing conservatism, you're going to select methods that are least likely to overstate assets and income. It doesn't mean that you purposely understate. So let's think about that. This is the least likely to overstate. So you would select historical cost. That would be conservative relative to market value. You would use historical cost rather than inflation-adjusted values. That is where we have a limitation on the ceiling. We also tell you that if you write an asset down because it is impaired, that is an exception to cost, but we're allowed to use market values if they're below cost. That's a conservative position. Now, when we say least likely to overstate assets and income, we don't mean that you purposely understate, because you can do that for a lot of reasons. If you purposely understate, so in other words, this does not mean to be over-conservative. In fact, you have to avoid over-conservatism. And in chapter 5, we'll talk a lot about income management, earnings management. When we say you want to avoid over-conservatism, let's say, for example, you have inventory, and let's say the market value declines. Let's say the inventory is $800. And here are your choices. Market value declines. And you might say, well, why don't you write the asset down? Well, you can argue that the decline in inventory may not be permanent. Right? It could be a temporary fluctuation in market prices. If you are conservative, you're going to write the asset down. Something that would not be conservative would be there would be no write down. Now, what happens with the position of being conservative? You take the loss, and let's put it over here so we can see it. So let's say it's 2019. So let's say write down is 100, 2019, no write down, 0. Income is lower here, income is higher. Now, here's a question. Does this ever reverse itself out? I mean, what happens in the next period? Does anyone know what will happen next period? Let's say I sell the inventory. Write down case, no write down. When you sell the inventory, what happens? What account is affected? What income statement account is affected? Cost of goods sold. So what happens to the cost of goods sold? In this case, if you didn't write the inventory down, it's going to be $100 higher. What happens to cost of goods sold? Cost of goods sold is increased and income is reduced by 100. So eventually, what will happen is this will shift income to the next period. So if you don't write it down now, it catches up in the cost of goods sold in the next period. And we'll show you that when we do the income statement and when we do the inventory chapter. So if you take the write down now, it's going to reduce income today. If you don't take the write down now, it reduces income tomorrow. Now, what that means is that you could be over-conservative and maybe take a write-down when you don't need one, and what does that do? It shifts income to the next period. So, when we say avoid over-conservatism, what if I decide instead of writing it down for 200, I write it down for 300, I write it down for 400. What I'm doing is I'm reducing income now, and then next period, my income goes up. So if I wrote the inventory down and I still sell it, then the profit gets larger. So if I had inventory at 800 and I write it down to 7, sell it for 1,000, my profit is higher because I now wrote the inventory down. So we'll see a lot of that, but over-conservatism would mean that you are writing inventory down, taking losses today more than you should, but it shifts income to the next period. You can think of any asset. What if you write down a building? Write the building down. Take a loss on a piece of equipment. When you go to sell the equipment, what happens to the gain? It has a lower book value. When you write it down, when you go to sell it, the gain is higher. So by being over-conservative, you're shifting income between accounting periods. You're shifting income between accounting periods. So what happens is that the inventory value that's higher, in this case, gives you a higher cost of goods sold in the next period. So if you write an asset down now, the loss is today. When you sell the asset, it shifts to the next period. So you could actually shift the losses back and forth. And that's what we mean by being over-conservative. Over-conservatism. Maybe this was perfect conservatism, but over-conservatism could be used to smooth income. You can shift income between periods by taking larger losses than you really should. So just want to be sure that when you look at conservatism, you don't factor or you don't think about that as showing the worst possible situation. That is not conservatism. Conservatism is not the worst possible. it's the position that you are least likely to overstate assets and income. Try to get the proper value. All right, so any questions on conservatism? I just wanted to be sure, we'll talk about this later, because later in the semester, because sometimes you might hear the term big bath accounting. That means that if I'm losing $2 million, I might as well lose $8 million. So I start writing everything off, and what that does is it shifts income to the next period. So by showing lower income today, you can show higher income later. So you can actually move income by being over conservative. You can also smooth income by being over conservative. You also create what are known as hidden reserves. We'll talk about that. So if you write the inventory down drastically lower than it really should be, you're creating a hidden reserve of income that when you sell that inventory, the profit goes up. So all of that is in violation of conservatism.
Yeah, so how does that work with the income reporting strategies?
Yeah, that would be where you might have a lower, you may want a lower income to maybe keep the government from seeing you as a monopoly. You may want a lower income this period to signal that next period will be lower income. So in other words, if I take big write-offs now, that means maybe I have enough income today, but I won't have enough income later. So that could be an income smoothing or a signaling strategy. Yeah, it does. It does. So in many cases, income reporting strategy, management, manipulation of earnings does violate these concepts. So even though we don't condone over-conservatism, it happens all the time. And a lot of companies, for example, Microsoft was always thought of as a company that used income-reducing standards. This way, they were less likely to be a target of, let's say, the Federal Trade Commission for a monopoly position. So we'll see a lot of the income reporting strategy as we move on. Okay. Any other questions on conservatism? One that I know you've seen before, business entity concept. Now, the business entity concept is usually something that you say you keep transactions in a business separate and distinct from the owner. But you must also keep all transactions related to the business separate from other related businesses or other related entities. So there's a lot of cases where you might have related entities. You might have off-balance sheet relationships. So you could have a partnership transaction with another company. If you take a look at Home Depot, Arthur Blank, the owner of one of the co-owners of Home Depot, also owns the Atlanta Falcons. So those two entities are not consolidated. Home Depot and the Atlanta Falcons don't prepare consolidated statements. They're two separate entities. But is it possible that Home Depot could be supplying, lawn care equipment to the Falcons for their stadium? And is that transaction an arm's length transaction? Are they selling, let's say, lawnmowers and tractors and whatever else they need to keep the property intact? Training facilities, are those supplies that they're using, are those being transferred at market value or below market? And is profit being shifted? So in other words, are you saving money for the Falcons and is Home Depot making less money, or vice versa? So again, they're separate entities, but yet they're not consolidated. They are off balance sheet. So you have to show this in disclosures. There are a lot of off balance sheet relationships. This happened with Enron. A lot more of them are coming on balance sheet today, but it is a lot more disclosure today than there was. And again, what we try to do is we look at the economic substance of the transaction rather than its legal form. So legally, Home Depot and the Falcons are two separate entities, but we sometimes have to look at the economic relationship between them. All right, so that's the business entity concept. And again, I didn't cover this because I know you saw it in the intro, but another part of business entity is, what about a sole proprietor? What about a partnership? And what about a corporation? Which one of those is a separate legal entity? corporation, partnership, sole proprietorship. Corporation is the only separate legal entity, but we treat partnerships and sole proprietorships as if they were separate legal entities. So I don't know if you know this or not, you'll see this in tax. You don't file a separate tax return for a sole proprietor. So if I ever did some consulting work, my business tax return doesn't exist separately, it goes into my personal return. Partners do not file separate tax returns. Partnerships don't file separate tax returns. A partnership return is an information return. So if a lot of you work, let's say in financial services, let's say you work in the tax department of a public accounting firm that handled hedge funds are partnerships, you generate a partnership return. It's an information return for the government, but the partnership isn't taxed as a business. The partners are taxed individually. So these are separate legal entities. So we treat them as they're not separate, I should say, they're not separate legal entities, they are accounting entities. So the entity concept also applies to treating partnerships and sole proprietorships as if they were separate entities, but they're not. And that's the other place it's applied as well. So corporations is never a problem, but for partnerships and sole proprietorships, we treat them as if they were separate legal entities, although they are not. All right, so those are the concepts related to the balance sheet. Any questions on any of those? All right. Now, concepts related to the income statement will involve revenue and expense recognition predominantly and the accrual base of accounting. Now, you've seen enough of the accrual base of accounting in Chapter 4. Revenue recognition and expense recognition is going to be, or the issues we want to discuss. Revenue recognition in the conceptual framework is the way you see it up on the screen and in the notes. In Chapter 8, which we covered in Intermediate 2, revenue recognition is much more detailed than what you see here. So it tells you revenue is recognized when an exchange takes place and the earnings process is complete. The earning process is complete when the seller does whatever they are supposedly supposed to do. And that is deliver the product, the customer has control of that product, and there are no outstanding performance obligations that are material. Now, you look at the definition of completion of the earning cycle, no material uncertainties as to future costs. And collection. Now, there's always uncertainty, but not material uncertainty. So we're saying no material uncertainty as to future costs and collection. Now, there is uncertainty as to future costs. What are your future costs when you sell a product? You sell it, you deliver it. What's still outstanding? What do you owe the customer? Just walk away and that's it? Or no, there's customer service, there's support. Can you estimate that? Yeah, based on past experience, you can estimate it. So examples here would be warranties. Customer support will be involved, and we can estimate that with a reasonable degree of certainty. Uncertainty as to collection, we know there are bad debts. So these can be estimated. As long as you can estimate them with a reasonable degree of certainty, you can recognize revenue. If, for whatever reason, you are unable to clearly recognize and estimate the amount of bad debts. Let's say the amount of bad debts you didn't expect, let's say your collection probability is very low, you wouldn't recognize revenue. And what would you use then? A cash basis. So if the probability of collection was so low, if there was so much uncertainty as to collection, you would not recognize the revenue. You'd have to wait to collect it. But in practice, we know from intro to accounting, you've got what? Some uncertainty, but you're able to estimate your bad debts based on past experience. So as long as you can estimate bad debt based on past experience, you can recognize revenue. So with no material uncertainty as to warranties or customer support, no material uncertainty as to bad debt, the earning cycle is complete. If the earning cycle is complete, you can recognize revenue. We'll find out in Chapter 8 and Intermediate 2 that when you sell a product, let's take an example of a cell phone. You sell a product, you got a cell phone, customer comes in, buys a package. What's the package? It's the cell phone plus cellular service and customer support. On the day you take the phone out of the Apple store or whatever the retailer is, you get it online. The phone comes to you, that's delivered, the phone is exchanged, right? You got an exchange, you got the phone, it's delivered, performance obligation is satisfied. What is still not delivered? Yeah, the customer support and the actual cellular service. So that is recognized over time because that has not yet been delivered and no exchange takes place. So in Chapter 8, we're going to find out that you're going to need to split that sale. The sale has to be split between the phone and the actual cellular service. And if it's sold separately, they have a certain price. If they're sold together, a certain price. And we have to find out what the exchange price is, and it becomes a little bit more complicated. That's the idea of the revenue recognition. So that's the revenue recognition. You need an exchange, you need a conceptual framework, and the earning cycle has to be complete. No uncertainty as to your future costs, and no material uncertainty. There is uncertainty, but you can estimate it reasonably, you're okay. And you can recognize the revenue. All right, so questions on Rev Rec, revenue recognition. Expense recognition. So you recognize revenue when it's earned, recognize expenses when they're incurred, and you used to, I guess, in intro to accounting, everything is matching, right? You think of always having revenues follow the expenses. But that's not true. If you look up on the screen, we look at revenue, expense recognition in three different ways. One, you can recognize it immediately, and that is associated with a specific period. So when you have expenses, they can be associated with a specific period, and that's where you recognize them immediately. And you have immediate recognition. So that would be wages, utilities, advertising. Second, you can recognize revenue over a period of time. These are not related to a specific period and not related to a specific revenue. So that would be depreciation, amortization. So here, immediate recognition would be, for example, utilities. As soon as they're incurred, you accrue them, right? Salaries, as soon as you incur them, they're accrued. Passage of time, an example here would be depreciation. I mean, you might say, yeah, straight line, it's 5 years, it'll take 1/5 each year. You're really just allocating it. You really don't know how that asset's being used, correct? You don't know for sure how much value is being used in that period. You're just allocating it based on an estimate. And the third, and this is where you would think of matching, this is where we're recognizing expenses. The third would be where we have direct association. And really, this is where the term matching comes in. Is we have cause and effect. And here, it's related to a specific revenue. So, you would have cost of goods sold, as I have on the board, on the screen rather. Cost of goods sold, sales commissions. Sales commissions are tied directly to a particular sale. Like you sell something, I give you 5%, direct association. Cost of goods sold, we said that before, we talked a little bit about the write-down and the conservatism, direct association. Another direct association would be warranty costs, right? So the warranty cost, the higher the sales, the more warranty cost you might have. So again, this would be direct association. Now, in general, what we have to worry about is whether or not, and we talked about this in chapter 4, when I showed you that diagram, that I have a cost I expend now. That cost can either be expensed immediately or capitalized as an asset. If you capitalize it as an asset, you would recognize it slowly over time. Those are your deferred costs. And I just want to remind you that this idea of capitalization is a choice. And we'll talk about, Tony mentioned this before, income reporting strategy. Sometimes you have to be careful because this idea of matching or direct association could be used as, unfortunately, an excuse to improperly and to justify improper capitalization of costs. So if a cost has a future benefit to it, it could be considered an asset and it could be deferred and allocated over time. So you have to be sure that that cost has future economic benefit. But it may or may not, depending on the company. So I'm going to go back, I'm not going to look at it now, but I'm going to just refer you back to Walmart. And in their annual report, when we look at their summary of significant accounting policies, in the SG&A section, Walmart said that they expensed in their SG&A, Walmart indicated that they expensed the cost of distribution facilities. So in other words, they get in all this inventory and then they will distribute it all over the country. They probably put it on their trucks and then ship them to all the stores. So they probably have a central location where they receive everything and then they distribute it. They said that their competitors add that cost to inventory. So they're helping you understand that when you look at Walmart, they're going to have lower income right now, And the reason why I gave you that simple example, although not a complete example for conservatism, is to help you answer this question. When do their competitors recognize the cost of those distribution facilities if they add them to inventory? When they sell them, right. So they're just delaying, they're deferring this cost until passage of time or until they actually sell it. So what will happen is they're adding to inventory, but then it goes into COGS when sold. So initially Walmart has the lower income, competitors have higher income, but eventually, you know, again, then by the way, you do this every year, it kind of washes out. Yeah. So,
Would there any, like, there's like 3 different ways, are any of them like better than another?
it's going to depend on, well, yeah, these are not choice, theoretically, these are not choices, so that if you get a utility bill, you accrue it immediately. If you've got a planned asset or any deferred cost that cannot specifically be allocated to a revenue or a period of time, you would take an arbitrary period to do that. So it might say 5 years, so that you have no choice when you do that.
Depends on the expense.
Depends on the type and nature of the expenditure. And then here, direct association. So here, basically, they're deferring, but they have a direct association. So what's happening, so I'm not going to ask you this question now, but eventually, as you build your depth of understanding of theory, this is a great question because you would say, if Walmart is expensing it now, immediately, they're basically treating this as a cost that gets immediate recognition. So they're using immediate recognition and their competitors, when they add it to the inventory, they defer or capitalize. And then here, when it goes to cost of goods sold, that becomes direct association. So when you read Walmart's annual, they're telling you we immediately recognize the cost of distribution facilities while our competitors defer it and then recognize it on a cause and effect basis. On a cause and effect basis. So that's and again, it would be based on the nature of the expenditure, but really more on how we account for it. So there is some choice there, but technically there's a certain type of cost that falls into each category. So you'll note that you could be more conservative. Walmart may be considered more conservative here by taking the expense now, almost like the write-down of inventory. Competitors less conservative and moving it out when it's sold. And I had a client that would capitalize cost of shipping and distribution, same idea. They would put it into inventory. So what they would do, actually I don't know if you've ever seen this company, it manufactures construction tools. They go out to construction sites, they actually give the products away free, but you gotta buy their parts that are marked up. So they would take the product come in from Europe, they would come to, let's say, Port Newark, they would have them in containers, they'd break them up, they'd put them on trucks, they'd deliver them all over the country. All of that cost of shipping would go into the inventory as freight in, even the distribution costs. Those costs were then capitalized in inventory, they were an asset, they were deferred until the product was sold, and then it hits the cost of goods sold, only when it's sold. And that would be a more conservative approach, I mean a less conservative approach, because assets would be higher in the beginning. They decided to change their accounting method, and we'll talk about accounting changes in the next chapter. They decided to change their accounting method and switch that to expensing the distribution costs. And when they did that, it became more conservative. Now, why do they do that? Reporting strategy could have played a role. Now, why do they change their method? And you have to ask that question. So originally they were less conservative, they were calling it an asset, the distribution cost. Later on, they decided to change that method, and we'll talk about the effects of accounting changes. So they decided to expense them later on in, at least my time with this client. And once they expensed them, their income was lower initially, rather than having it as an asset. Well, what was the nature of the expense? I guess it could go either way depending on management's choice. It's a good question. All right, so any other questions now on the expense and revenue recognition? Now, all of this is based on accrual accounting. So we know, I'm going to summarize with this, that this should be on the top of the next page, I guess. Depends on how your notes were printed. But a cash basis of accounting is not acceptable. Only the accrual basis of accounting is required under GAAP. Now, there were some examples in the homework on cash versus accrual. Cash basis simply means you recognize revenue only when you collect cash, expenses only when you pay it. The problem with the cash basis is that it does not recognize economic activity. It only recognizes cash receipts and disbursements. And I have a comment here that if you think, we're going to talk about income strategy a lot, if you think that GAAP onto the accrual basis is easy to manipulate, cash basis is even easier to manipulate because all I need to do is write a check, I've got an expense. Pay some cash, I've got an expense, even if I don't use the asset. So if I go to, Home Depot to buy supplies, cleaning supplies for my business, or if I go to Staples or WB Mason and buy office supplies, as soon as I spend the cash, it's an expense, even if I don't use those supplies or that inventory. Revenue, I can generate revenue by billing early, even though it's unearned, it's cash, it's income. Or what I can do is I can hold my invoice. So if I don't want income in September, and I finished a job for you right now, let's say I was your accountant, and I finished some kind of a tax return or maybe an amended tax return for you today, I hold my bill, I send it to you in October, I don't have revenue in September. Accrual basis, it's income. Cash basis, it's not until I collect it. So again, the problem to cash basis, it does not measure economic activity. It only measures cash receipts and disbursements. Now, we know very well from Chapter 4 that the accrual basis is preferred, recognizes revenues when they are earned under the revenue recognition concept, recognizes expenses when they're incurred under the expense recognition model we have up on the board, gives rise to accruals where economic events occur before the cash event, such as accrued interest, accrued salaries. Deferrals, economic event is after the cash event, just like Walmart's competitors. They paid distribution costs, they put them into inventory, that's the cash event. Deferred economic event is when it's sold. And that's when they recognize the expense. So, I know you had a couple of questions on that, but the accrual basis is considered superior mainly because it recognizes economic activity. And we know there can be manipulation. A lot of the questions you were asking today shows your understanding that by moving numbers around, we talked about conservatism, the choice of capitalizing or expensing something will dictate how income is shifted. So you can use conservatism as an excuse. I want to write this off now because it's conservative to do so, but yet that'll shift income. And it may be part of strategy or reporting strategy that may not necessarily reflect income properly. All right, questions on accrual or cash? Anything else? I know we have a couple of homework problems on that. Okay, the last concepts. I'm not going to do all of these because some of them are repeated. Monetary unit assumption, that basically means that all transactions have to be reflected in some type of monetary unit. In the United States, of course, the US dollar is used as the measure of financial accounting transactions. And one of the things that we build into the time period, I should say in the monetary unit assumption, one of the things we build in is that we ignore inflation We assume that the purchasing power of the dollar is stable. How do you apply that concept? Well, let's say you bought land in 1973, and that land was $200,000. If you buy land again today, in 2018, 45 years later, that same land could be $1,800,000. The fact that you add those up in the land account to $2 million means that you're assuming that the purchasing power of 1973 dollars are the same as 2018 dollars. So this assumes a stable price level. Now, we know it's not true, but it's the way we operate in accounting. The way accounting operates, it is going to add dollars of different purchasing power. That's like the it's the apples and oranges that you're adding up. They're not the same unit of measure. So, two things on the monetary unit assumption, or actually three things. Number one, all transactions have to be measured in a monetary unit. Second, of course, the unit we use here are US dollars. And the third is we ignore any price level changes. We ignore price level changes.
How does conversion work?
Okay, so in terms of currency conversions, you mean like from one trade? Yeah. Currency conversions, if you have a subsidiary in a foreign country, before you consolidate, there's no inflation issue. Let's assume there's no inflation, nothing adjusted for inflation. You just simply convert the dollar to, or the currency to the US dollar.
So what does it mean to the current exchange rate?
The current exchange rate, or historical, it depends on the type of asset. You'll find out in advanced accounting that current assets and liabilities, we use the current exchange rate. Sometimes for plant assets, we might use the historical exchange rate, the rate that existed on the date we bought the asset. And income statements and cash flow statements use the average exchange rate because it's a flow. Because theoretically, you should be translating sales every single day, but you take an average. In some countries where there's hyperinflation, we do adjust statements first for inflation, then we adjust them for currency. But in the United States, we don't have. We used to have price level adjusted information. We don't have it anymore. Inflation is not considered to be a major issue in the United States. Our rate of inflation is not that high. 1978, inflation was pretty high. I think I mentioned mortgage rates were like 20%. And there were disclosures that would give you price level adjusted information. Nobody used them, so they went away. Remember we said generally accepted accounting principles have to be accepted by the majority of accountants. If no one's using them, they go away. So we did have price level adjusted information in the footnotes. We never converted our statements themselves. But some countries before, depending on where the subsidiary is located, you sometimes need to convert first or adjust for inflation, and then translate back to the dollar. And you could have translation gain. You could have gains and losses on that translation as well.
What would be key points for the monetary unit?
All transactions have to be, if you're reporting on financials, you have to monetize them in some way, right? So you have to have the monetary unit. In, of course, the United States, it would be the US dollar, but whatever the local currency would be the monetary unit. And the third thing is we assume a stable price level. We'll see a little bit of translation here, but not much. That's more of a advanced accounting topic. Anything else on monetary unit? Primary issue here is the stable price level. Time period assumption. Well, we know we artificially truncate the life of the business into those periods. We talked about this at length in the discussion of the adjusting interest. The problem with the time period assumption is you have to cut off at a certain period of time. That's when you have to measure transactions. That's when you have to come up with your adjusting interest. A full disclosure just means that information has to be complete, and you have to provide all the information that would avoid any misleading conclusions being drawn from the statements. And finally, these modifying conventions, we know about the cost constraint, not going to do that again. We also know that materiality is part of relevance, but you should also look at that as a constraint. Again, materiality means that it is significant enough to influence the judgment of a reasonably informed user. And then another constraint could be industry practice, because remember, you're not going to be dealing with anything except brick and mortar type companies in this course. There are exceptions. So we talked about fair value accounting. The insurance industry, most of their assets are carried at fair value, because their investment portfolio is carried at fair value. So there's lots of differences on different industries. And then finally, I want to bring conservatism in here, because that's a constraint as well. Because sometimes when you're deciding on the accounting method to use, again, you select the one that's least likely to overstate assets and to overstate income. So it does put some type of constraint on your choice of accounting method. According to US GAAP, the period of time elements include investments by owners, revenues, and comprehensive income, and others. Now that is true, because over a period of time elements are the flow elements. What are the others? Who wants to help me with this? And I'm starting, as I'm going to get this done, as I said, because we just finished at the final rosters. I'll be calling on you again. But what are the others? What are the others? What are the other flow elements? What are the other elements in the period of time? Over a period of time. Expenses, gains, losses, and what else? Distributions to owners. So not only investments by owners, but distributions to owners. And you also have gains, losses, and expenses. Any other questions or any questions on that? So you have to know the point in time and period of time elements. What are the point in time elements? Assets, liabilities, and equity. All right, number two. It's true, only the accrual basis is acceptable. Cash basis is not acceptable. Now, I'm going to ask you some questions on fair value accounting. Numbers 3 and 4, so let's go to number 3. Quoted market prices in active markets are the measure of fair value that is neither the most observable or least observable. This what A is true, B is false. And all right, so wow, a 50-50 split there. This is exactly why we asked the questions. All right, think about the hierarchy, the fair value hierarchy that's disclosed. What are the levels? 1, 2, and 3. What's level 1? Quoted market prices. Level 1 is the most reliable set of inputs, and it is the observable. If you get a quoted market price, it's observable. So the answer is, in this case, false, because it is the level 1. And remember, let's read the question again. It said quoted market prices in active markets. That is neither the most nor the least. It is the most observable. So unobservable inputs cannot be used to report fair values. Let's see what you think there. Again, we're back to the hierarchy. All right, so this one, again, is unobservable inputs cannot be used. It is false. So if you put true, let's make sure you know why that is wrong. Unobservable inputs are level 3. It's a level 3 value input to the valuation process of fair value. Level 3 is based on management's estimation models, and we allow that, but why do we allow it? Because we have the disclosure that tells you, hey everybody, it's a level 3. What does it mean? Don't place too much reliance on it. It's based on management's assumptions, management's modeling, and therefore it is the least reliable set of inputs going into the fair value measure. So we can use it, but it's the least reliable. All right, questions on that? Number 5, going concern will justify depreciation. That is true. It also justifies the long-term classification of assets. It is absolutely true that going concern will be assuming the business operates for an indefinite period. Therefore, you depreciate an asset for 40 years would make sense. If you thought you were going to liquidate, you would depreciate the asset over that period. You'd write it off for at least fair value of that asset. And finally, number 6, the periodicity or the time period assumption stipulates that an entity will continue to operate for an indefinite period. That's false. That is actually what concept is.
Going concern.
Going concern. Okay. All right. Good. Multiple choice. Balance sheet elements are point in time. That's B. Balance sheet would be a point in time. We already did this in the true-false. That's why I'm going to go over them myself with you. Make sure you have the answer. So this is point in time balance sheet. On a U.S. GAAP, what's an example of period of time elements and what statement does it appear on? Well, the only correct pairing there is sales revenue and income statement. Because receivables balance sheet, that's a correct pairing, but what's wrong with that? It's a point in time element, not a period of time element. Depreciation expense, statement of stockholders' equity, that should have been income statement. Salary payable balance sheet, that's correct as a point in time element. And sales revenue and income statement, period of time element with the correct statement. Questions on that one? Number 3, peripheral activities, incidental activities would be gains. So we know that gains are from peripheral or incidental activities. And the same thing, and I ask these questions sometimes just to show you that the wording could be different. And that's why I sort of warn against memorizing problem format or memorizing certain questions, because now I'm going to ask the same question in a different way. Here I said peripheral incidental transactions, that would be gains. The next question, we ask the same concept. The primary distinction between expenses and losses is not the verifiability, it's not the timing, not the amount, but it is what? The nature. Is it peripheral or is it part of operations? So it's the same question asked in a different way. So just warning to not memorize, to make sure you have the concepts down. Now, we also talked about, in number 5, where do we get a trade-off when we use fair values? Yeah, it's got to be relevance and faithful representation. It's got to be relevance and faithful representation. Fair values are more relevant, but they may lack faithful representation. So if I use a level 3 measure, that lacks faithful representation, but the fair value is going to be more relevant. Six, company reports net income every year. Concept is, all right, and finally, the company is bankrupt. What concept is not relevant? Going concern. Because in bankruptcy, you would not have a going concern. In fact, you would be valuing everything at liquidation values. You would also, by the way, I could change this question, and I could say, in bankruptcy, which concept is not relevant? If it didn't have going concern, then what if I said the cost principle? Cost principle wouldn't be relevant in a bankrupt entity either. So going concern or cost principle here be both equally acceptable, because if you're in a bankruptcy, historical cost is no longer valid. No longer valid. You can use liquidation values. Okay, so yes, it's Number 4? Yeah. Number 4, the expense versus losses. So we know that expenses are part of normal operations. Losses are part of peripheral operations. That's the nature of the expense. That's what differs. So the only distinction, they're equally verifiable, correct? I mean, if I had a loss or an expense and I had an invoice, or if I sold a car and I have a canceled check, I could verify them. In C, the timing, there's no issue as to when something is recognized. I mean, you could have an expense and you could have a loss in the same period. And the amount, materiality, they don't differ. I could have a loss or an expense of $1,000, or I could have a loss and an expense of $1 million. No difference. So the difference is really the nature. You know, is it from normal operations or is it from peripheral operations? All right, any other questions on the conceptual framework? So we went through lots of questions on this on Sunday, so if you review the video, you'll see a lot of sample questions that you can look at, but again, the concepts are really the most important part of that. Because again, that can always vary some of these questions. All right, so now, what we need to do is spend the remaining time to get into chapter 5. And so now we're going to look at income statement and comprehensive income. So the first thing we want to do is to talk about the differences between the two. And still, it's going to be overview, going very slow, lots of concept, until we start getting into computations a little bit later. You've got earnings quality, you need to talk about permanent and transitory elements of income, and also the income statement elements. When you look at comprehensive income, we have to think about comprehensive income as the sum of net income plus other comprehensive income. Other comprehensive income we'll talk about in a second. Net income, you know what that is. It is the performance of the company based on revenues, expenses, gains, losses, net income or net loss for the period. Other comprehensive income. Now these are items of revenue, expense, gain, and loss that do not flow through the traditional income statement. They're excluded from the traditional income statement. They're typically paper gains and losses. They're usually not included in the income statement because of a low probability of short-term cash realization. So an example would be is if you were holding a security to maturity and you value that security at market, if it's in your portfolio of pension, you're not going to sell it. Your wealth goes up, but yet it's not going to go on the income statement. An example, let me give you an example of something you just asked me a few minutes ago. What if you had a UK sub? And we know that the exchange rate is, let's say right now, this year, 1 British pound is $1.30. So let's say you invested some assets in there and you have 100 British pounds. When we convert that to the US dollar, it's 130. That's in year 1. In year 2, let's say that the dollar depreciates. So now the exchange rate is 1 British pound at $1.40. Using the current rate, those same assets, let's say nothing happened, you didn't do anything in this sub, you have 100 British pounds, but when we convert them to the US dollar, they're worth 140 bucks. Now, that is an unrealized gain, right? So now your assets are worth more when you consolidate them and you have a gain. The question is, are you going to realize that gain in the short term? What would you have to do? You'd have to go into the British sub, liquidate it, sell it off completely, get the British pounds, and convert them into dollars and bring them back to the US. What's the likelihood that's going to happen? If you're in business in England or in Great Britain and you want to continue in business in Europe, what's the likelihood you're going to sell that sub? A little low. So therefore, that unrealized gain is $10, that's other comprehensive income. Your wealth has gone up, but it did not affect your net income. Yeah.
So would the same thing apply for like stocks too?
Yeah, certain securities that you hold, debt securities, if you're holding investments in bonds in another company, and those go up, and you don't intend to sell them, they're not trading in nature, those gains and losses go into other comprehensive income. The same thing's true with pension assets of a company. If the pension assets of a company go up and down, you're not going to liquidate the pension plan. So the whole idea is that, there's lots of other reasons too, that it's not, you're not in business to deal in foreign currency, right? So that's not your operations either. Number one. Number two, you're not going to realize it. And the other problem is if I put those into income, what's going to happen to net income in the long run? These are transitory components, which we'll talk about in a second. Your income will bounce all over the place. The British pound and the dollar fluctuates each year, so you're going to wind up with income that is volatile. So this avoids volatility in net income as well. So other comprehensive income is exactly what you see there. It is an increase in your wealth. It's from non-owner sources. It's from all transactions except for transactions with owners. Anytime your wealth goes up, you've got income, but is it operating net income? Is it part of your earnings, or is it other? And if it doesn't go on the income statement, it's considered other comprehensive income.